Picture this. You are right in the middle of a profitable trade, but you are nervous because you think price will reverse soon against you. Or you lost a trade and immediately after you enter another one, trying to recover the lost money. Or the price is almost hitting your stop loss and you decide to move it far away, hoping and praying for a break-even trade. If this is a common scenario for you, I have several solutions for these problems. Developing a strategy is the easy part in trading, but the mental aspect of trading is where most people struggle. Today we'll talk about that, the science behind profitable trading. So if you could, like, subscribe to the channel, and stick around for the full video. Trading is often a game of timing the market. The more timing is important to your system, the more important is to avoid pulling the trigger early on a trade. That ability to wait for the right moment, whether to wait for a pullback, or a completion of a price pattern, or a confirmation from an indicator, can mean the difference between success or failure in trading. Good trading is all about waiting. Waiting for the correct setup, waiting for the right entry, waiting for the trade to play out, waiting to exit a trade, and then waiting all over again to enter the next trade. If you can find that you can't wait and keep entering the trade too early, see if you can make some adjustments to your system, such as using price or pattern alerts, and implement a way of keeping yourself away from the charts for those minutes that would normally see you jumping in the trade too early. This technique is especially effective if you're swing trading and you're using the higher time frames. And remember that trading is all about playing the long game. It's important to associate waiting with good feelings, so you can feel good about waiting, and try to avoid the feeling that you should be doing something, because you'll soon start taking trades against your strategy. The more complex a system or series of filters in your strategy that determine whether a trade is valid, the more difficult trading becomes. The smaller the cognitive load you have to bear in order to take a trade, the clearer your mind will be and the easier it will be to perform the action. Look at what you are really trying to achieve. Often, it's simply to find a low-risk way of entering the daily momentum to take out a piece of the market. The multitude of trading systems out there are mainly trying to do the same thing, which is to take a piece out of a strongly moving market. If that is the case, then the simplest way of doing this is going to be the easiest for you to implement. Keep your system as simple and streamlined as possible. So the trick is to make your strategy logical, simple but effective. If it makes sense, then you can consider it. If it doesn't make logical sense, get rid of it. And try to view the information with the correct perspective, rather than waiting for magical levels like overbought or oversold, without understanding the underlying logic of why that may occur. You want to focus on price and how the market reacts to that price, how much volume, how quickly it moves, how far it moves to get there. Consider these aspects logically, consider what it means, and then make your conclusions for what movements can happen next. If a trade is bad from the start, nothing you can do will help. It's best to exit the trade as soon as possible to avoid doing any further damage to your account. Unfortunately, traders can become attached to a trade and will hold it in the hope that it may turn itself around. The problem is that even if the trade did work out this time, you are setting a dangerous precedent for future trades. If it does come back and rewards you with profits, you will never learn that cutting your losses is the best route to go and can lead you to trading habits that will eventually destroy your account. Many traders see losses as threats and they try everything to avoid a sure loss, even if it means gambling and possibly losing much more. Look at a simple but common example. The market has reached a level where, if it breaks it, a multitude of orders will flow into the market. and a missed exit could mean a far worse price if and when you decide to close out your position. So next time you find yourself in a trade that isn't working, don't wait in the hope that it will work out or start moving your stop loss further away. That money could be put to good use in other trade that would work out. Watching and worrying about the result of your trades after you have placed them can be counterproductive and leads to exiting too early and moving stops closer or further away. Basically, you are undoing the research that got you in the trade into the first place. It's best to let the market do its work. Here's my solution to reduce trading anxiety while you're in a trade. Each time I place a trade, I consider it lost from the beginning. When I hit the buy or sell button, in my mind, that trade is already lost. I accepted the losing outcome right from the start. This way, I know what to expect from the trade. I don't feel the urge to revenge trading, to constantly check the price, or to move away my stop loss. If the trade indeed turns out to be a loser, I was already mentally prepared. I already visualized my account balance being down 2%. And if the trade is successful, it's like receiving an unexpected gift. And trust me, it's better to be surprised than frustrated. So, before you place your trade, you need to have already determined that the money you risked on that trade is gone. When you have determined the risk capital in a trade and have already subtracted that amount from your balance, then there is very limited emotional response you should get from a loss. Rather than wasting time or losing sleep over things that you have no power over, what you can and should focus on is assessing probabilities. You should focus on finding opportunities and defining your risk prior to entry, because in the end, those are the only things you can control. I mean, you do realize that you don't have to be right each time you interact with the market. You don't even need to be correct 50% of the time to make money. Unfortunately, most traders, regardless of their experience level, are incapable of realizing this. Most choose to focus efforts on whether the next trade will be a winner or a loser. So what's the solution? Rather than looking at the outcome of a single trade by itself, view it as one outcome among a set of outcomes. You need to analyze your trading strategy and take into account different parameters. Trading expectancy, which is the average amount a trader can expect to win or lose using a particular system. The win-loss ratio, how many trades produced a winning reaction over how many concluded a loss. The risk-to-reward ratio, which is the average size of a profitable trade divided by a typical losing trade. If you understand that your trading system has a positive expectancy, a high probability of making money over the long term, you won't stress whether the next trade will be a winner or not. Most traders follow either an essentially objective or subjective trading style. Objective traders follow a set of rules to guide their trading decisions. They prefer to have buy or sell decisions essentially pre-planned. In contrast, subjective traders adapt to changing market conditions and base their trading decisions more on their judgment regarding a specific trading opportunity. Subjective traders are usually more vulnerable to being guided by emotion rather than reason in their trading decisions. My advice to you is to try to eliminate subjectivity from your trading approach, especially if you are a new trader in your first years. It's a good way to reduce your emotional involvement. Objective trading can also be referred to as rule-based trading. You follow a clearly defined set of rules for entry, exit, time frame, and markets. It's pretty much a matter of just entering, letting the trade play out, either hitting the profit target or being taken out by a stop loss. This trading approach may also have rules for adjusting profit targets or stop orders based on the market action. However, as an objective trader, you'll usually be much less active in this regard than a subjective trader. Due to the relative simplicity of objective trading, it's ideal for new traders who lack the skill and experience required for complex market analysis. A set of rules to guide both trade entries and exits can lower the stress level and the psychological pressure that novice traders may naturally feel. Ever been afraid to pull the trigger on a trade or felt afraid to trade altogether? This is basically trading anxiety, and it affects all traders at some point. You know the feeling. When you see a trade, it's a perfect setup for your system. You have confirmed it exactly as you should, but you are hesitating to pull the trigger. This trading anxiety comes from the lack of trading confidence. And this happens when you don't have confidence in your trading skills. Perhaps you have no enough trading knowledge, or you don't have a stable trading plan or a decent strategy to help you ease your trading stress. If you relate to this, you need to develop a confident trading mindset. The longer you trade with patience and discipline, the more it will pay off. If you consistently trade day by day, strictly following your trading plan, you will soon develop positive trading habits, which one day will evolve into sound trading confidence. And of course, success is the key element which drives confidence. There are no better arguments that can make you feel really confident than a winning trade, or even better, a series of winning trades. So even if you close a trade with little profit, even a break-even trade, that's still a win. You didn't lose money and you learned something. Another way to build confidence is to keep track of your winning and losing trades. And again, don't get obsessed with the outcome of any single trade. Instead, put your energy into consistent and disciplined trading practice, which will eventually teach you to avoid mistakes. We tend to hold too many expectations for ourselves. We stress because we want the markets to behave in a certain way. You probably have seen a lot of stories of traders who turned $1,000 into $1 million within a year. You've seen traders telling you that you can quit your full-time job and start trading for a living. The problem is that many traders are chasing unrealistic returns, 50% per week, 10% per day. A lot of people who are attracted to trading are part of a get-rich-quick crowd. And there's nothing wrong with wanting to get rich quick. But the fact is, quick in trading rarely means 1 year. You need to accept the fact that you will not be making a lot of money while trading in the beginning. So no, you will not be quitting your job to trade full-time. Do it as a side business in your first years, even if you are profitable. For those reasons, it's vital that you make sure you align your expectations with your general trading approach. You can make money trading, but only by being patient, setting realistic goals, and taking your time. This is the safest route, and it will not happen overnight. If you found value and learned something new, leave us a like. This way we'll know if you'd like to see more videos like this one. And check out our Academy program if you want to further level up your trading. Until next time.